This video will demonstrate the journal entries for issuing stock, the how-tos and the wherefores. Par value is an arbitrary amount assigned to shares of stock. When preferred or common stock is issued, the par value of the stock is credited to the stock account. Any amount received above par, called a premium, is credited to paid-in capital in excess of par. First example, Belson Corporation sold 1,000 shares of $10 par value common stock for $17 per share. Debit cash, a current asset, for the 1,000 shares times the $17 per share sales price, or $17,000. Credit common stock for $10,000, an equity account with a normal credit balance for the 1,000 shares times $10. And then paid-in capital in excess of par dash common stock gets the difference of $7,000. The dash common stock is simply to identify it as being specific to common stock. Now, another example, Belson sold 1,000 shares of $25 par value preferred stock for $30 per share. The cash received is $30,000, which is 1,000 shares times $30 per share. The preferred stock account, again an equity account, gets credited for $25,000. That would be the 1,000 shares times $25 par value. And paid-in capital in excess of par dash preferred stock will get credited for $5,000. No par stock does not have an assigned par value. Some states require that a stated value be assigned to any no par stock. If a stock has a stated value, it is treated the same as a par value in recording the stock. The stock account is credited for the stated value, and any premium is recorded to paid-in capital in excess of stated value. If a no par stock does not have a stated value, the full proceeds from issuing the stock are recorded in the stock account. For example, Camden Corporation issued 100 shares of no par preferred stock for $50 per share. Our cash received is $100 shares times $50 per share, or $5,000. And because it's a no par stock, no stated value, the full amount of $5,000 is going to get credited to the preferred stock account. And another example, let's say they issued 500 shares of common stock with a stated value, $5 per share, sold for $7 per share. Now we're going to debit cash for the amount received of $7 per share times 500 shares, or $3,500. We're going to credit the common stock account for the par value, or $2,500, and then we're going to credit paid-in capital in excess of stated value dash common stock. When stock is exchanged for another asset, use the fair market value that is most easily determined, the value of the asset received or the stock given up. Camden Corporation also issued 1,000 shares of $5 stated value common stock in exchange for equipment with a fair market value of $8,500. Equipment would get debited for the $8,500. We'd credit common stock for $5,000 and credit paid-in capital in excess of stated value dash common stock $3,500.